So we're live. We're live, Amar. And
I
if
think
you're,
we are.
yeah, and so if you're
All
watching
right.
our live stream, okay, there you're not blurry anymore. I was going to say Cary Smith is the one who's clear, and Amar Shah is the one who's blurry, but you're not blurry any longer. So, um, hey, Amar, I know you're a numbers guy, and I know you like digging into the numbers, and so I don't want to turn anybody off by saying this, but what we're talking about today is numbers. We're talking about you don't need your calculator, right? At least not yet. But what we're talking about is the five numbers that you should know about your retirement, right? And this is not, this is not one of those what is the magic number you need to know to be able to retire. This is not that. This is really looking at your retirement scenario and understanding the five key numbers that are important for you to know for you to have a good, successful retirement.
Yeah.
So let's jump in and talk about this.
And right before we jump in, we got to do the compliance piece of our
Yes,
part
yes,
here. And we have a disclosure here. The first thing is that this is strictly educational purposes. We haven't entered into a client agreement based off of your situation. This is not specific advice for you, right? So with that out of the way, let's talk. And we'll go from there.
okay. So, the first number that we want to talk about that I think is probably the first number you really need to know when you're retired or preparing to retire, and that is what are your expenses? How much money do you need to live on each year? Um, Go ahead.
I agree. I mean, in retirement, this one number has so much weight
Yeah,
on your success in retirement because it's a number that you can control. It's a number that you can edit. You can kind of uh, do some due diligence around. Am I spending in the areas that I want to spend in? There's so much value in understanding your expenses. I agree. For most people, it's a hard thing to do to budget and to find their expenses. But if you take the time to put pen to paper and really know what your expenses are, it'll be a big eye opener in terms of how much are fixed expenses, how much are variable, how much do I need to live off of, how much does my investment portfolio need to grow to maintain these expenses. It opens up a lot of insight.
yeah. So, Mar, about 2.5 years ago, I retired from, a corporate career,
There you go.
and one of the first things I did, and actually I did it before I was completely retired. I had some flex time in there, but man, I went detailed on a budget. Right, I was including Netflix and estimating my wife's car mileage and how far she drives, and then myself as well. And I was getting very detailed on that budget, but it also gave me the confidence to know, okay, this is what I need. These are the extras, the vacations and the things that we want to do, and the travel and those sorts of things. And we put that number together. But it really is one of the numbers that when you know that number, at least for today, you have confidence in what you need, and it takes out a lot of the ambiguity and a lot of the guesswork, and you don't have to worry about your portfolio as much. Now, but for long-term retirement planning, you can't just look at today, right? You got to be thinking about, when am I going to need a new car? Is the house going to need significant maintenance? Is there going to be a future, a second house or a vacation house, or all of those sorts of things? You can't just look at your expenses today, but you got to forecast ahead to know what are the things. A lot of these things are the things that are in your dreams right now. House maintenance is probably not one of those things, although it needs to be forecasted for.
Yeah.
But the fun things that you want to do, that are going to cost that you're going to need some cash to be able to do those. You want to make sure you're capturing those as much as you can.
Yeah, and I would call with what you just said as the gold standard of tracking expenses, but an entry level position to get into tracking your expenses It's just to know how much are you spending total,
Mm-hmm.
right? So I think it's good that we give viewers a starting point and what would be the gold standard.
Yeah.
Right?
Okay.
So when we go into our next bullet point here, which is your net worth, right? Net worth is defined as your assets minus your liabilities, right? A lot of businesses do it as a uh, part of their balance sheets, but it's really for you to know, all right, where are my assets? How much do I have? Um, you know, in terms of a gold standard of that is calculating your net worth and the long-term financial security that it can provide by defining how much is liquid net worth, how much is non-liquid, how much is tied up in real estate, how much is tied up in business ventures, how much is tied up in liquid cash or stocks, and the liquidity timeframes for those.
Yeah. Yeah. It's key because, if your first number is your expenses, then your second number needs to be, what are the resources I have to meet those expenses, right? And so it makes sense that, getting your arms around your net worth is critical. And that's a number that I think a lot of people kind of track ongoingly at a high level. But once you retire, or once you get close to retirement and you're really planning, it's good to get down and know what that number is. To your point, kind of like a balance sheet, in a company, right? It's not guesswork. It's usually, it's pretty detailed.
Yeah. So what would be the starting line to try to figure out a net worth, right? Let's say you've never done this before, right?
Mm-hmm.
The first place that you can start is look at your statements and just write down the dollar amount that you have in those statements. If you own a house, you can go on like Redfin or Zillow or one of those websites and what's the estimated value of your house, right? You have debt. Again, you can look at those statements and what is the payoff amount, right? And you can input those things to get a basic net worth. Now, the gold standard, which we were talking earlier, you may have some ratios in there that you want to look at and say, where do you feel comfortable? Like, i.e., if I have a lot of real estate, for example, and that real estate has a very low cost basis and low liquidity, how much cash do I need to keep on hand as an emergency fund for that real estate asset, right? And so you can balance that out and really get into the weeds of, knowing what your resources are. So the third thing that we have is liquid net worth, right?
Yeah.
And I would say this is emergency funds, cash reserves, your safety net, right? This is what's going to bail you out if something happens to the negative in terms of markets or asset prices or business values, if you will.
Yeah. So when I think of this is different than, the emergency fund that I would recommend maybe a young person have in their career, which is usually stated in, 3 to 6 months of living expenses in case one of you lose your job or something of that nature. I think of this one more in terms of a year or years, of having, having a larger pool so that, to your point, that you don't have to sell assets, most likely assets in your portfolio, at a loss or in an inopportune time, or at a time where you're missing out on opportunity, but you've got some funds set aside.
Yeah. I was an advisor in 08, right? In 09. The earlier parts, especially where people still needed liquidity. They still needed money, right? The water heater was still breaking down. The need for a new car was still there, right? So life continues regardless of the markets. And I think it's important to consider that liquidity component. So we talked about just understanding how much your needs are from a pure expense standpoint, looking at that at years. So I think the gold standard of this is really understanding, your assets, how much volatility does those assets have? If you have pensions, how much does that offset your fixed expenses by? Articulating that further out. And you're right, you need to plan for years instead of months because, investments, there have been times in history where investments have been in bear markets for 3 years or more, right?
That's
And
right.
in retirement, it's very important to make sure you have that liquidity to weather that storm. So then those investments have an opportunity to bounce back.
Okay, so some people, right? So like our clients, their money's being, professionally managed, and we're selecting, where we can keep those assets so that they're performing as good as they can and getting as good of a return. But if you're managing it yourself, where are you putting those funds?
Yeah, that's a good question, right? Because traditionally we used CDs and short-term bonds, right? And you know, as of lately, they've done well because there was an increase in interest rates. But
That's
there was
right.
a period of time where they didn't do so well, right? And so people started to say, well, where can I get a higher yield? That higher yield led to more risk, right? And so what we kind of look at is really investments that have a 5-year or less time horizon, something that could be in a structured product where there's a defined outcome that's coming from those type of investments. And here, really, if you can keep pace with the 2-year treasury, you're doing really well, right?
Yeah.
In terms of a benchmark, if you will.
Okay. So, our fourth number of
Yeah.
the numbers we need to know is, what is your safe withdrawal rate?
Yeah, and this is a big one because I believe a lot of people just go off of rules of thumbs, like the 4% rule, or I'm gonna, look at different percentages, different depending on when I get my Social Security, when I get my pensions kicking in. And this safe withdrawal number depends on also what your investment makeup is, right?
Mm-hmm.
If your total return is X and you get about 80% of that total return paid to you in terms of income, well, you have a higher amount of certainty that you're getting that income versus if it was equity growth where it's going up and down, makes up a larger percentage, then you have some variables there. The other thing that has variables is based off your age. If you're in early 60s, you can withdraw 3 to 4%. Sure, that can last you a long period of time. But when you're in your 80s and 90s, you can definitely withdraw higher percentages of your overall net worth because there's a longevity factor there, right? And
Yeah.
so we've seen clients in the 10 to 12 to 15% range in the later years of life. But really knowing what a safe withdrawal rate is allows you to identify the stress on your portfolio. I mean, at the end of the day, that's what we're looking to do is can your assets manage that type of withdrawal or that type of stress?
Mm-hmm.
In upward markets, most can. Sideways markets, maybe a little bit less. And then what happens in a downward market?
Yeah. I know when you and I talk about withdrawal rates, as we're talking about clients, and you always use the terminology stress on portfolio, right? You think
Right.
about it as the stress that a portfolio is under to be able to generate those kinds of safe withdrawals. And so, and I don't think people always look at it as the stress on the portfolio, right? But
Right.
that's I think a very good way to speak about it for people to just internalize the importance of that number a little bit more.
Sounds good. Yeah. So let's go to the last number 5, which is, what is your planned success rate, right? If you take all these things that we talked about so far, combine it into a financial plan, you get a probability of success.
So probability of success, Monte Carlo scores, right? These are words that, we hear a lot when we're talking about this subject. And people are all over the place when it comes to, what percentage they feel, if you're a person who just has always played it safe in business, you like a sure bet. So you like to be in that, that 95 to 100% range, right? But that's usually not the best case scenario for someone who's living in retirement. And there's, there may be, more flexibility, right, in their plan to make sure that they can, enjoy a good retirement and that there's things Yeah.
The probability of success really defines is if there's going to be a change in cash flows in the future, right?
Mm-hmm.
So a lot of us can feel comfortable with 100% chance that there's no change in cash flows, right? We're going to have, but what that means is on the opposite end, you're leaving dollars on the table that you could have spent, right?
Sure.
So for most of our clients, I think a comfortable number has been, 80 to 85%,
Mm-hmm.
where, there's an 80 to 85% chance there's no change in cash flow. There's a 15 to 20% chance that, yeah, there may be a change in cash flow. And, one of the problems with success rate, it doesn't identify the impact of that change in cash flow. So that could be $1,000 a year. That could be $10,000 a year, or it could be $100,000 a year, right? It's not articulated in those numbers, right? In the probability number.
So this number is important. I don't know if any one of these numbers is more important than the others, because they're all important. This is an important number as well, in that, so let's just say if your probability is too low, right? If let's say that you're coming up with a probability of 65 to 75%. What would a person do in that scenario?
Yeah, so the action steps are really defined around how can I raise my probability score by looking at my expenses, right? By looking at the withdrawal rate or the asset mix that I'm in my investments, like where's those replenishing from, and have I done a tax advantage way to make those withdrawals? Because taxes are big expenses in retirement, right? Is there ways that we can reduce that? And so when we're looking at that, those are the things that we would consider first, right?
That's right.
Another things that we can consider is just delaying those experiences that you're having. If you're traveling on a big trip every quarter, well, why don't we expand that to maybe every 5 months or every 6 months? That reduces the burden on your portfolio, which then raises your probability of success.
Right. And if a person hasn't retired yet and they're looking at this number, sometimes that will tell them, you know what, I need to work a year longer than I had planned, or maybe 2 years longer, or I need to take on some part-time work once I retire, right? So a person might, juggle some other different options around as well, as they're looking to make sure that they have an appropriate success or probability rate.
Yeah, I agree. So should we recap the 5 here, Cary? And if you're on the stream and you have questions, we have a bunch of free time that we can answer that over the next 5 minutes here. So I'm going to start with the recap first. So the first financial number you should know about is your expenses. Then we talked about your net worth, then your emergency funds. And then we talked about making sure that you know a safe withdrawal rate from your what's recreating your income or what you're taking from a portfolio, and then making sure your planned success rate, Monte Carlo, that you identify that number as well.
Yeah, very good.
All right. Remember, we have our Client First Capital learning channel where you can find out more learning topics on retirement planning, estate planning, tax planning. And Cary and I put out a newsletter that comes out once a month. You can go to clientfirstcap.com and you can subscribe there to learn more. All right, Cary.
Okay, Mar.
Hey, I'm gonna end it then.
Okay, all right. This was a good discussion.
All right, good.
Right.
All right, bye.
See ya. Bye.